Welcome to the deep dive. We're digging through corporate filings, research notes, auditor opinions, all that stuff, so you get straight to what really matters. Today, we're focusing on, well, a giant of Indian industry, the Steel Authority of India Limited, SAIL. Our mission to unpack sales performance in the first half of fiscal year 26. We talk financials, operations, and the whole picture. And look, on the surface, the numbers really do look dazzling. Standalone profit after tax paid, it jumped 32% year over year, hit hours 11,112 crore. Sales volumes, they soared 16.7%. I mean, that sounds like just flawless execution, right? But when we really dug into these auditor reports, we found this huge conflict. SAIL might have booked at hours 11 and 20 crore profit, yeah, but the auditors, they simultaneously warned about these massive contingent liabilities. These are unresolved legal claims that, well, if things go the way the auditors think they might, could wipe out over hours 1,270 crore from the company's net worth, more than the profit they just announced. So that's a tension we really need to explore today.
You've got these spectacular operations clearly riding a domestic boom, but they're shadowed by this massive regulatory risk. Before we get too excited about the profit numbers, let's just set the scene a bit. Is sales success purely down to them being super efficient internally? Or are they riding some kind of massive economic tailwind? What was the global steel environment actually like while they were posting these big numbers?
Yeah, that's absolutely the right place to start, because the global context, honestly, it wasn't rosy. Not at all. Sales numbers really stand out against what was happening elsewhere. The global macroeconomic recovery, post-COVID, Russia-Ukraine war instability, it's been gradual, very gradual. The IMF, for instance, they're projecting world growth rates around, 3.3% for 2025, maybe 3.1% for 2026. And okay, yes, those numbers were revised up slightly in late 25, but they still signal, pretty cautious lower growth compared to previous years. What's really interesting, though, is this ongoing split. Emerging and developing economies, they're still projected to outperform the advanced economies. So growth is definitely uneven across the globe.
Okay, let's unpack that a bit. Slow, gradual global growth. That doesn't usually spell boom times for a heavy industry like steel. So how did this global economic picture specifically translate to, say, global crude steel production?
Well, it pretty much confirms that caution. Global crude steel production, it's actually been declining. It was down about 2.9% in the calendar year 2024, and it fell further, another 1.6% in the first 9 months of calendar year 2025. China, of course, still dominates massively, about 53.4% of global production. But even China saw its own production dip, about 2.3% compared to the same period the year before. And the demand side, the short-range outlook for steel demand, the one from World Steel back in Op24, confirms this softness. They expected global demand to actually decrease by 0.9% in 2024 before projecting, a pretty modest rebound of just 1.2% in 2025. So yeah, globally, environment soft, production's down, demand is kind of struggling.
Right. That really puts sales, 16.7% sales volume increase into incredible perspective, doesn't it? The global climate is struggling, yet sales is just surging ahead. And this, I suppose, is where we pivot to India, because India seems to be acting as a complete counterweight to all that global gloom. India is still, one of the fastest growing major economies out there. We've got major agencies projecting pretty healthy GDP growth for the coming fiscal year. The World Bank sees 6.3% for FY26. The IMF projects 6.2%. And the RBI, India's central bank, is looking at maybe 6.8%. Strong numbers.
And this domestic strength, this is absolutely the core of sales success story right now. The data couldn't be clearer. India is projected to have the highest steel demand growth globally. In both 2024, that was projected at 8.0%, and 2025 projected to be 8.5%. That is just a massive sustained tailwind for any steel company operating here.
Yeah, and if we look at something like the Index of Industrial Production, the IIP, we can sort of see which sectors are pulling that steel demand along. The IIP showed improvement across almost all the use-based areas during FY25. The only exception, interestingly, was consumer non-durables. So that tells us the main drivers are things like robust activity in large-scale infrastructure projects, capital goods manufacturing, basically the sectors that eat up huge amounts of steel.
Okay, so if the domestic market is this strong, how well is SAIL actually capturing that demand? Let's zoom right into their specific H1 FY26 standalone snapshot. Crude steel production looked steady, right? 9.503 million tons. And total sales volume was almost exactly the same, 9.462 million tons.
They are capturing it exceptionally well. I mean, look at that 9.462 MT sold 9.280 MT, so almost all of it was domestic sales inside India. And if you dig just a bit deeper into their sales breakup data, a staggering 94.2% was categorized as CMO home sales.
Yeah, okay, CMO home sales. What exactly does that mean for someone listening who might not, live and breathe this kind of corporate jargon? Good question. So CMO stands for their Central Marketing Organization. It's their internal sales arm. And home sales just means selling within India. So essentially, over 94% of their sales volume is being channeled through their own marketing setup straight into that booming Indian infrastructure and manufacturing market we were just talking about. They are deeply, deeply reliant on and very successful in the domestic market right now.
And financially, that success translated into revenue from operations clearing Rs, 52,625 crore. EBITDA reached Rs, 5,754 crore, which of course leads to that impressive Rs, 1,112 crore profit after tax we mentioned at the start. And beyond just the profit, it looks like they're also, tightening the belt elsewhere. Debt on an Ind-AS basis, it fell to Rs, 33,663 crore. That brought their debt-to-equity ratio down to pretty manageable C.60.
Yeah, and we absolutely have to acknowledge the internal discipline too. That's driving efficiency even before we factor in the massive demand pull.
Let's look at the techno-economic parameters, the efficiency metrics, blast furnace productivity, for example. It improved to 2.08 tons per cubic meter per day in H1 FY26. That's up from 2.02 in the full year FY25.
And the coke rate, another key one.
Right.
That improved too, right? From 626 kilograms per 1,000 kilograms of hot metal down to 618. Now, to an outsider, that might sound like a tiny, really technical detail, moving the coke rate by just 8 kilograms. But on a balance sheet the size of sales, producing millions of tons of steel, how much actual cost savings does something like that translate to? Oh, it translates directly into hundreds of crores of rupees in savings over a full year. Easily. Coke is a major, very expensive input, so reducing consumption by 8 kilograms for every ton of metal produced, that's a massive operational achievement. It's honestly the kind of thing that separates profit from loss when market conditions eventually get tighter. And we also see their product mix reinforcing that whole infrastructure story. Their production is heavily weighted towards flats.
Right, flats used in machinery, cars, big fabrication projects.
Exactly. That's about 49.3% of their mix. And then longs, things like rebar used in construction, that makes up another 35.7%. So it's clear they're really optimized to serve the construction and large-scale manufacturing booms happening across India right now.
Okay, so everything we've discussed so far paints this picture of a company performing, well, spectacularly, benefiting from maybe the best possible macro environment, domestically at least. And here is where we need to switch gears. We move from the celebratory results presentation slides to the, let's say, the fine print of the statutory auditor's limited review report, because this is where we find the real cracks in the foundation, maybe. The auditors, as they have to, flagged several really big disputes. Now, management classifies these as contingent liabilities, meaning, potential future losses they might have to pay. But the auditors are pushing back. They're demanding that the company recognize these as immediate provisions now, and that's a critical accounting difference.
It is. That demand for provisioning is exactly what gives us that R's torn in 274 crore figure we mentioned. If a provision is recognized, it hits the balance sheet immediately, reduces net worth right away. Let's maybe break down the three major regulatory disputes they highlighted. And it's interesting, they all seem to stem primarily from disagreements with state utilities or tax authorities. Mostly it seems in Chakhand. Okay, the first one is this entry tax dispute in Chakhand. The sale is facing a disputed tax demand of about Rs 108 crore, Rs 108.28 crore to be exact. Now, the key thing here is that the constitutional validity of original Entry Tax Act itself was actually upheld by the Supreme Court. That significantly weakens sales case, even though this specific matter is apparently still pending before the High Court's regular benches. So the auditors are basically saying, look, the legal risk here is now so high, you really need to set aside the money, make a provision.
Okay, that's the first one. Then we have this rather complex DVC tariff dispute. This concerns electricity charges from the Damodar Valley Corporation. So management got a refund from DVC, about Rs 351.75 crore. But crucially, this refund included an interest component of nearly Rs 169 crore, and management apparently just adjusted the entire amount against previous advances they'd paid.
Right, and the auditors jumped on this. They state that by doing this, SAIL is non-compliant with a very specific accounting standard in AS 109. Basically, this rule requires companies to recognize interest income separately from the principal amount they recover. You can't just lump it all together. By doing that, the auditors argue SAIL is essentially distorting its financial results for the period.
And the auditors didn't stop there in the DVC case, did they? They piled on more scrutiny, expressed serious reservations about whether SAIL can even recover another Rs 448 crore in total advances paid earlier to DVC.
Exactly. They explicitly note that the audit team hasn't been given enough evidence to confirm the basis on which that large advance will eventually be recovered or adjusted. So that suggests nearly, what, Rs 450 crore is kind of hanging in the balance right now with the state utility provider.
Yeah.
Big question mark there.
Wow. Okay, but the single largest dispute, the real elephant in the room here, is the water charges dispute. Again, with the Jharkhand state government, this time the Water Resources Department. This involves a truly staggering demand of ours, 11,146.4 crore, that's over 1,100 crore, and it's due to revised water rates. The state imposed a massive jump from Rs 4.50 to Rs 26.40 per thousand gallons.
It is staggering, exactly. And the auditor's concern here seems to be grounded in legal precedent and the current status. SAIL initially challenged that rate notification in court, but that challenge was dismissed by a single bench of the High Court. Now, okay, they have appealed to the division bench, it's true. But in the meantime, management is already paying Rs 18 crore every month under protest just to keep operating.
They've already paid Rs 72 crore as of September 30th, 2025, just under protest. Right. And the auditors cite another accounting rule here. In AS 37, this is the standard that governs provisions, contingent liabilities, and contingent assets. And essentially what that rule says is, if a potential loss is both probable, likely to happen, and measurable, you can estimate the amount for, then the company absolutely must create an accounting provision for it immediately. The auditors clearly view that initial court loss, plus the fact they're already paying under protest, as strong indicators that the liability is probable, hence provision needed. So let's just put that all together. If the auditors' views on these three big issues, the entry tax, the DVC accounting, and recoverability questions, and especially that massive water charges demand were actually adopted, the reserves available to the company, their net worth essentially, would have shrunk by Rs 1,274.20 crore, which means the potential legal risk they're carrying is financially larger than the Rs 11,112 crore profit they just reported for the entire 6-month period. That is, I think, the core takeaway here.
It absolutely is. And we probably shouldn't overlook the significant inventory risk the auditors also flagged. It's separate from those regulatory disputes, but it's still quite concerning. SAIL is apparently sitting on almost 40 million tons, 39.89 MT to be precise, of something called subgrade iron ore fines. It's a lower quality iron ore byproduct. Now, this inventory is valued on their books at 3,836.86 crore, almost 4,000 crore. And that value is based on its net realizable value, basically, what they expect to eventually sell it for.
Okay, so why is that a risk then? If it's valued, why can't they just sell it or use it?
Because the dispatch permission, the permit to actually move and sell this material, is still awaited for the critical Topeler lease, which is again in Jharkhand. So this is where you see regulatory bottlenecks hitting operational valuation directly. Management sounds optimistic about getting the clearance, sure. But until that permit is actually granted, that nearly Rs 1,000 crore valuation is, well, theoretical. It's stuck. The auditors noted this uncertainty specifically because the fundamental ability to actually dispose of or even utilize that huge pile of inventory is currently blocked by a regulatory delay, another risk hanging out there.
Right. Okay, so let's try and summarize our deep dive then. On one hand, SAIL demonstrated truly impressive sales volume growth and profitability in H1 FY26, no question. Largely benefiting, it seems, from India's projected world-leading steel demand growth driven by infra and manufacturing, plus some clear internal efficiency gains in key areas like coke rate and BF productivity.
Absolutely. That operational story is powerful. It really speaks to the company's ability to execute within that favorable domestic market. However, when you step back and take that critical view, you absolutely have to acknowledge these significant legal and financial contingencies. That combination of the entry tax issue, the DVC accounting and recovery questions, and especially that enormous water charges dispute, collectively, they pose a potential hit of over around 70 crore to the company's net worth. And this isn't just speculation. This is what the statutory auditors are explicitly highlighting and pushing for provisions on.
Exactly. And that leads us directly to a final provocative thought for you, the listener, to consider. Given that the total financial debt of a public sector giant like SAIL stands at over Rs 26,400 crore, and at the same time, they're facing well over Rs 12,250 crore in these auditor-flagged contingent liabilities, mostly from really long-running regulatory and state utility disputes. What will be the ultimate long-term cost for SAIL to finally harmonize its massive sprawling operations with India's incredibly complex and clearly still evolving regulatory and judicial environments? How much really will those ongoing regulatory costs potentially eat into future growth and profitability? Something to think about.